Is FIRE dead in 2026? What the math actually says format, single-host educational podcast voice. James, warm professional, target, approximately 2,200, 2,500 words. For most of the last decade, the path to early retirement felt like a paint-by-numbers exercise. Save 50% of your income. Dump it into an S&P 500 index fund. Withdraw 4% a year, and call it a day. The FIRE movement, financial independence, retire early, went from fringe blog post to mainstream financial aspiration in what felt like the blink of an eye. And for good reason. The math worked. The 2010 S gave us the longest bull market in modern history, near-zero interest rates, and a social media culture that turned frugality into a competitive sport. But we're not in the 2010 S anymore. It's May 2026. Inflation is hovering around 3%. The Federal Reserve has gone from cutting rates to talking seriously about hiking them again. Rate hike odds jumped from 1% to 45% in a single month. Brent crude oil is above $110 a barrel because the Strait of Hormuz is effectively closed. The S&P 500 versus equal weight spread hit 13.8%, a level that's only been this wide twice before, signaling extreme concentration risk in the largest companies. And the Dalbar report for 2025 showed that even in a relatively calm year, the average equity investor still gave up 72 basis points to behavioral mistakes. So the question people are asking, the one that's popping up on every personal finance forum and YouTube comment section is FIRE dead? The short answer is no. The long answer is more interesting. FIRE isn't dead, it's just grown up. And like any adult, it had to accept that the easy assumptions of youth don't survive contact with reality. Let's start with the rule that FIRE was built on. The 4% rule. Originally proposed by financial advisor William Bengen in 1994, it stated that a portfolio of 50% stocks and 50% bonds would last at least 30 years if you withdrew 4% of the initial balance in year one and adjusted that dollar amount for inflation each year thereafter. Bengen analyzed historical market data going back to 1926 and found that, in the worst-case scenarios, retiring just before the Great Depression or the 1970s stagflation, 4% worked. But here's what's critical to understand. Bengen's study assumed a 30-year retirement horizon. That's someone retiring at age 65 and living to 95. If you're pursuing FIRE, if you want to retire at 40 or 45, you're looking at a 45 to 55-year retirement horizon. And the math changes dramatically when you stretch it that far. Multiple financial analyses in 2026 now recommend a withdrawal rate between 3.25 and 3.5% for early retirees. That doesn't sound like a massive difference, does it? 50 basis points, 0.5%. What's the big deal? Here's the big deal. On a $1 million portfolio, 4% gives you $40,000 a year. 3.25% gives you $32,500. That $8,000 difference is significant, but it's not the real problem. The real problem is sequence of returns risk. Sequence of returns risk is the idea that the order of your returns matters just as much as the average of your returns. If you retire in 2026 and the market drops 10% in year one, then another 15% in year two, you're not just losing portfolio value, you're withdrawing from a shrinking portfolio. A 4% withdrawal during a bad sequence can exhaust your portfolio in 25 years instead of 30. And if you're trying to make it 45 years on 4% withdrawals through a volatile decade, the probabilities get ugly. There's actually a counterintuitive bright spot here that most FIRE critics ignore. High interest rates are painful for borrowers, but they're fantastic for conservative portfolio construction. In 2026, high-yield savings accounts are paying 4 to 5%. Government bonds are yielding at levels not seen in decades. You can build a bond ladder that provides a guaranteed income floor. This was completely absent in the ZIRP era, the near-zero interest rate environment that defined most of the 2010 S and 2020 S. Back then, cash was a liability. In 2026, cash is a legitimate asset class again, so the math has changed. But that's adaptation, not death. Let me tell you about the idea that's quietly become the most important FIRE concept of 2026. It's called Coast FIRE. The idea is simple. If you save aggressively in your 20s and early 30s, you can reach a point where your portfolio will grow to your FIRE number by traditional retirement age, even if you never contribute another dollar. You stop saving for retirement, you coast, you keep working, but you keep all your income for living expenses. You remove the pressure of the 50% savings rate. Let's run the numbers. A 22-year-old invests a lump sum of $30,000. That's not even a year's worth of maxed-out contributions in some markets. At 7% average annual return, which is below the S&P's historical average, that $30,000 grows to roughly $600,000 by age 65, without adding a single additional dollar. That's the power of compound interest over 4 decades. Now imagine that same 22-year-old contributes something every year, even a modest amount. The growth curve gets steeper. The crossover point, where investment returns exceed contributions, happens faster. And that's the whole philosophy of Coast FIRE. Front-load the math. Let compound interest carry you the rest of the way. Stop running on the retirement savings treadmill. Then there's Barista FIRE, which is Coast FIRE's slightly more practical cousin. Barista FIRE means you have enough invested that you only need to work part-time to cover the gap. You might work 20 hours a week at a coffee shop, hence the name, or consult, or freelance, or run a small business. The income covers your living expenses. Your investment portfolio stays untouched and compounding. Plus, you get health insurance, which, in the United States, is arguably the hardest variable to plan for in early retirement. In 2026, Coast FIRE and Barista FIRE have risen to the top of FIRE movement trends for a specific reason. They solve the 2 biggest failure points of traditional FIRE. The first is portfolio math. Because you're not fully withdrawing, or you're withdrawing much less, your sequence of returns risk plummets. The second is psychological. Dalbar's 2025 report showed that the investor behavior gap narrowed to 72 basis points, the third smallest since 1985. Why? Because investors stayed invested. And you know what helps you stay invested? Not being fully dependent on your portfolio for survival. Coast FIRE and Barista FIRE give you a glide path, not a cliff. Let's talk about the actual portfolio. The old FIRE playbook was S&P 500 and chill. 100% VOO or equivalent, aggressive, and faith in the long-term trend. That worked in a bull market. In 2026, with the S&P 500 versus equal weight spread at its widest since the dot-com era, concentration risk is real. The 10 largest companies now represent an historically disproportionate share of the index. If those companies correct, and everything in financial history suggests they will, the 100% VU approach takes a beating. The 2026 FIRE portfolio looks different. A common framework emerging from multiple sources is what's called the floor and ceiling model. The floor is your minimum survival expenses: housing, food, insurance, transportation, healthcare. The ceiling is your comfortable spending, the number that lets you travel, eat out, and enjoy retirement. 60% goes into diversified global equity ETFs, total market, not just S&P 500, international exposure, small and mid-cap. Not because they're exciting, but because diversification across geography and market size reduces the damage when any single market regime fails. 25% goes into the income layer. This is where 2026 is different from the 2010s. You can build a bond ladder at 4+% yields. You can use a CD ladder. You can hold a portion in high-yield savings accounts earning competitive rates. Cash is not trash in 2026. It's a legitimate portfolio component that generates real returns. 10% goes into what I'll call the alpha buffer. Alternatives, maybe real estate investment trusts, maybe gold. But here's the critical point. With Brent crude above $110 and inflation stickier than expected, you need assets that respond to the environment we're actually in, not the one you hoped for. And 5% stays in pure liquidity. Cash that you can access without penalty, without liquidating a position, without waiting for settlement. Because if 2020 taught us anything, it's that the market can freeze up, and having 5% in pure liquidity means you never have to sell into a panic. Now let's talk about the FIRE critique that doesn't get enough attention, the psychological one. Multiple studies have shown that a significant percentage of early retirees struggle with loss of identity, social isolation, and purpose drift. You spend a decade obsessed with the number, saving every dollar, optimizing every decision, and when you hit it, there's a void. The financial math works, but the life math is incomplete. The FIRE movement trends in 2026 have started emphasizing Phase 2 planning, identifying what you'll actually do with your time before you leave your career, having something to retire to, not just something to retire from. The investors who succeed over the next decade will not be the ones who made the boldest predictions or reacted fastest to every headline. They'll be the ones who stayed calm while markets got noisy, the ones who understood that successful investing has always depended less on predicting the future perfectly and more on managing human behavior during periods of uncertainty. So let me give you the practical takeaway. The actionable math. Not as advice, this is educational, not advisory, but as a framework for understanding your own numbers. Step 1. Know your numbers. Calculate your floor and your ceiling. Most people don't actually know what they spend. Track it for 3 months. The numbers might surprise you. Step 2. Build the bridge. If you're retiring before 59 and a half, you cannot access retirement accounts without penalty unless you have a strategy. The Roth conversion ladder is one approach. Convert traditional IRA funds to Roth. Wait 5 years, withdraw the converted amount penalty-free. A taxable brokerage account is another option. An HSA funded to the maximum is the secret weapon, the stealth IRA that's triple tax advantaged. You need a bridge that gets you from your retirement date to age 59 and a half. Step 3. Build income optionality. Coast Fire and Barista Fire aren't compromises. They're insurance policies against the unknowns that traditional fire can't predict. If you can generate some income, even a modest amount, your withdrawal rate effectively drops below whatever number your portfolio says. And step 4. Prepare the person, not just the portfolio. FIRE is a financial strategy, but early retirement is a life transition. They're different skills. If you solve the money problem but ignore the identity problem, you might find that the retirement you fought for doesn't feel like freedom. Here's what I want you to take away from this episode. FIRE in 2026 is not dead, it's harder. The withdrawal rates are lower. The portfolio needs to be more sophisticated, and the psychological preparation matters more than it did when markets were easier. But the core insight, that compound growth, disciplined savings, and intentional spending can buy you the most valuable asset on earth, which is time. That insight is more relevant in 2026 than it's ever been. The investors who will succeed over the next decade will not be the ones making the boldest predictions. They will not be the ones reacting fastest to every market headline. They will be the ones who understand that emotional discipline itself, the ability to stay invested through 30% drawdowns, geopolitical chaos, and social media hysteria, may be the rarest and most valuable skill in the entire FIRE toolkit. Compound interest isn't the eighth wonder of the world. Patience is. The math was never the hard part. The hard part is showing up year after year, through bull and bear, through war and peace, through inflation and deflation, and trusting that the system works, even when the news tells you it doesn't. FIRE isn't dead, it grew up, and the people who adapt, who understand the real math, who build the right portfolio, who prepare psychologically, those are the people who will actually achieve it. This is Wealth Unlocked. Financial literacy, not advice. Subscribe for the math the algorithm won't show you. We'll see you next week.